The TSX in record territory, led by the materials sector, fueled by the possibility of a Fed rate cut, which could in turn bolster some Canadian companies. That has investors wondering if the TSX does have more room to run. Let's get a perspective. Kyle Taylor, wealth advisor and portfolio manager at TriDelta Private Wealth, joining us in studio right now. Thanks for coming in.
Thank you.
Okay, so first of all, what's your take on the record territory? We saw all of the North American markets yesterday close higher, and the TSX now sort of flirting with 28,000 points. What are your thoughts on the rally? Well,
it certainly seems like the AI rally has once again taken a firm grip on the market. And that begs the question of how can Canada participate in that respect? We've talked a lot about how the US market has such concentration. It's very top heavy and can stand to benefit from the AI theme and a lot of those tech companies. But in Canada, we have a different type of concentration issue where almost a third of the index is financials, followed by energy and materials. And if you break it down, financials, they've had a really great run and been able to support the TSX year to date. But if you look under the cover, banks, they're expecting to grow earnings 4% over the next 12 months. Oil's been kind of stumbling along, and materials has really been the star, especially gold. In fact, over the next 12 months, gold miners are expected to contribute 40% of the overall TSX's earnings growth. So it really gets into, can the existing themes continue, and can we bet on the recovery into 2026 from the economics perspective?
Okay, let's talk about earnings as we've seen them so far. What is your take as we move towards the finish line? What are your sort of key takeaways, both in Canada and the US?
Well, the key takeaway on both sides of the border and globally was the fact that it was an impressively low bar for company earnings going into this quarterly earnings season, given all of the uncertainty that we saw in April and May coming off of the tariff dynamic and unfolding story there. So I think that has played a key role in some of the wide beats that we've seen. And people are betting today on a recovery into 2026, rate cuts in the US and further rate cuts in Canada. And once again, just growth has really taken on the investor psyche moving forward.
When you say it's a low bar, is that because at the start of the year, the uncertainty was so much higher? Remember, we saw companies saying we can't even provide guidance because we don't know what is to come. So even if they sort of provided that guidance now and maybe squeeze out some earnings, it was a good day. It
really feels like analysts gave companies a bit of a break, given all the unknowns that were, pretty clear at that time. But moving forward, we've seen estimates trend higher for Q3 and Q4. I think the Canadian banks will be a good indicator for the Canadian, what's in store for the second half of for the TSX in regards to the consumer spending and from an economics perspective. But really our approach, whether it's a bull market or a bear market, what's important to us is our investment process really doesn't change. It's something that we've developed over 20 years, and there still are opportunities in the market.
Follow through on the AI theme for me, because as we know, and as you mentioned, the American market is overweight with that, so they're clearly benefiting. And we know that energy, especially Canadian energy, could benefit from this as well. What else could we see benefit, and how long could you see the benefits lasting?
Well, one of the going back to the makeup of the TSX relative to the S&P, the top 10 companies in the S&P right now make up about a third of the index. Top 20 make up half. You go back a decade, the top 20 companies in the S&P made up only 29%. Speaks to the top heavy in the AI theme. In Canada, 8% is weighted towards infotech, primarily Shopify. Speaking about other themes that could benefit and help Canadian companies, I think we really need to see more strides towards how is AI positively impacting businesses in Canada and helping them grow. In terms of other areas, one of the themes that we've had a lot of success with in this year is in uranium. Just the sheer volume of power that's needed to support AI and the data centers is something that can benefit Canada and can benefit commodities and a lot of companies here.
Let's go through a couple of your top picks here. We're going to start with Maple Leaf Foods. You have a new target price of $41 and an outperform buy. Mm-hmm. What are you seeing in Maple Leaf Foods? So they are doing well. The trend is up at this point.
Yeah, so Maple Leaf Foods was actually one I was on here speaking about in May, and since then has had a really great run in share prices. They're a consumer packaging meats company and an agribusiness, which helps support some of their businesses. Primary markets, Canada and the US. They really haven't been impacted by tariffs as much as maybe people had feared in April and May. You add on the fact that they're still trading at a pretty reasonable 18 times forward earnings, just shy of a 3% yield. One of the key events for the second half of the year for them will be the the spin out of Canada Packers from their business, just from a multiple perspective that we think that could add $4 to $5 to the shares today. So that's something that we're actively watching and a company that we continue to like.
Okay, let's talk about New Gold. We talked about gold generally. You think it's going to be a big driver moving forward. New Gold under that umbrella. Tell me about it.
We do see the gold theme continuing in Canada. New Gold is an interesting pick because they have two main operations, one in Ontario, one in British Columbia, and they just posted their second quarter earnings very recently. They had a record quarterly free cash flow posting. And what was interesting to me is if you sum up the next 3 years of estimates for free cash flow for that business, it actually equates to their current market cap. So for me, that adds a lot of confidence to maybe we'll see dividends, share buybacks, or just some investment in expansion. Trading at a 5 times forward earnings, we think it's pretty attractive.
Okay, let's get to your last pick as well, because we want to hit the third one before we have to take a break, which is Rogers Sugar. That one surprised me. You've got a sector perform on this and a target price of 7. It's at 6.14. We thought sort of sugar stocks aren't going to be doing so well because people are more conscious about their sugar content these days. But what do you like about the stock?
So they have two primary segments, general sugars with diverse product mix, and they also have maple sugar and syrup as another segment. They posted a phenomenal second quarter earnings report, which would follow a great Q1 earnings. It's mainly driven by the maple segment, which they saw growing global demand for the products. They grew U.S. sales by double digits, so which really speaks to the evidence that maybe tariffs are not impacting them a whole lot. And they're yielding 6%. So this is a company that we've owned for quite some time. It's something that we have a fair bit of conviction in as a long-term hold, and pays you to wait for that growth that we continue to expect.
I'm going to say that's sweet, but I wouldn't really say that early in the morning is too early for jokes. Yeah. Okay, thanks very much for joining us, Kyle Taylor, Wealth Advisor, Portfolio Manager, TriDelta Private.